The hidden credit crisis, shadow banks and the next financial shock. One. What's really going on? Everyone expects interest rates to fall and stay low. Why? Because markets are bracing for credit losses. But here's the twist, it's not traditional banks on the chopping block. It's shadow banks. These are funds and private vehicles that act like banks but aren't regulated as banks. They borrow heavily through short-term markets like repo, then lend where regular banks won't. Sounds clever until things go wrong. And lately, things look wrong. So what does that actually mean? A hidden world of risky lending may be sitting on losses no one is ready to admit. Footnote. Shadow banks mimic banking without regulation, leaving credit risks hidden in the system. 2. How we got here. After 2008, regulated banks never bounced back. They played it safe, loading up on government bonds and high-grade debt while refusing riskier lending like small business loans or mortgages. This left a giant hole in credit markets. Shadow banks rushed in, offering clean balance sheets with no baggage from past crises. But their magic trick was leverage. Borrow short, lend long, and hope nothing breaks. Classic recipe for disaster. Footnote. The retreat of regulated banks after 2008 allowed shadow banks to dominate riskier credit markets. 3. The boiling frog. In the 2010s and early 2020s, shadow banks thrived on optimism. The so-called recovery after lockdowns looked hot. Inflation made things appear even better, at least on paper. Investors reached for yield, ignoring warning signs. Jay Powell said the economy was resilient, and everyone nodded. But underneath, borrowers were stretched thin. Rising delinquencies in the regulated system were easy to see. Shadow banks just buried theirs. Selective defaults and extend and pretend became the norm. So what does that actually mean? Instead of admitting trouble, they just kicked the can down the road. Footnote. Shadow banks disguise stress with accounting tricks, fueling complacency. 4. April's wake-up call. Then came April. Markets cracked, not just from tariffs but from repo market stress tied directly to shadow banks. Treasury data showed U.S. banks funneling emergency cash to offshore funds that weren't even posting Treasury collateral. Translation, they were desperate. For the first time in years, liquidity providers started asking hard questions. And the answers weren't pretty. Hidden defaults, rising risk, and nobody sure what anyone actually held. Sound familiar? That's exactly how 2008 spread. Footnote. April exposed shadow banks' fragility, echoing the opacity that fueled 2008 contagion. 5. The numbers behind the curtain. Data is scarce, but some reports paint a troubling picture. Standard & Poor's found selective defaults outpacing regular ones 5-1 in 2024. Lincoln International flagged shadow defaults in 6% of deals, up from 2% in 2021. Bloomberg reported similar rates in the $1.7 trillion private credit market. Tricks like payment in kind let borrowers delay obligations, but reality catches up. When loan-to-value ratios balloon from 45% to 83%, it's not creative financing. It's a red flag. Footnote. Independent reports confirm defaults in private credit are rising fast, often masked as modifications. 6. Why it matters. Here's the danger. Credit problems in the shadows can spill into money markets. Liquidity dries up. Contagion spreads. Not 2008 level catastrophe, but enough to turn a slowdown into something nastier. Especially since regulated banks are tied to shadow banks through funding and exposure. So what does that actually mean? Even if big banks don't fail, shadow bank losses could choke credit flows, magnify recession risks, and trigger serious volatility. Footnote. Shadow bank stress threatens liquidity and amplifies recession risks, even without bank collapses. 7. The road ahead. Right now, default rates aren't apocalyptic. But if unemployment climbs and revenues fall, today's 5 to 6% could easily double. That's why markets expect the Fed to cut rates aggressively. Powell already admitted he was wrong about the labor market. The question is, how long before he admits he's wrong about everything else? Shadow banks won't tell us the full story. Which leaves one lesson: keep watching the shadows. That's where the real danger lurks. Footnote: rising unemployment could push shadow bank defaults much higher, raising systemic risks.